In this video, I'll be showing you the best strategies that you can use to earn profits on a ranging market. So first, an important concept that you need to understand is that in the world of technical analysis, there are two types of market that exist: trending markets and ranging markets. Trending markets is when the price is clearly moving in a definitive direction. If it's going up, it's called an uptrend, and if it's going down, it's called a downtrend. Now, usually, this is the type of market that traders prefer to trade on because the movement of a trending market tends to be more predictable. On the other hand, you have ranging markets, which is a type of market where the price moves erratically without having a definitive direction. Now, usually, traders tend to avoid this type of market because it's a lot harder to predict where the price will go next. Another reason on why traders tend to avoid ranging markets is because most indicators tend to not work properly on them. An example of that will be the MACD indicator. So here, if we try applying the MACD indicator on this ranging market, you can see that it's showing us multiple false signals, and as a result, we ended up with mostly losing trades. Now, unfortunately, ranging markets are pretty much unavoidable. In fact, study shows that the financial markets only trend about 30% of the time, while moving on a sideways range about 70% of the time. This means that most of the time, markets are actually ranging. And so, instead of trying to avoid them altogether, why not try to take advantage of them? And that is why in this video, I'm going to show you the best strategies that you can use to earn profits on a ranging market. So strap in, because we're going to go very in-depth. So first, in order to earn profits on a ranging market, we first need to know how to actually identify them. And normally, ranging markets are a lot easier to be identified after they have already formed. But if they're still in the process of forming, it tends to be harder to spot. And so a simple trick that I like to use to identify ranging markets as they're forming is to pay close attention to the market structure. Let me show you an example. So here, we can see that initially, the market was clearly on an uptrend. Now ask yourself this: why is this an uptrend? Well, it's because of how the price is structured. Here, we can see that the price went up, made a pullback, and comes back up again. However, notice that as the price goes up, it actually breaks the previous highs. And it did this multiple times, forming what's called a higher highs and higher lows, because the highs and lows of the price is constantly getting higher and higher, which is why this whole movement is classified as an uptrend. But notice what happens next. We can see that the price went up, comes back down, but this time, it failed to break above the previous highs. And again, you can see it happening the second time. Price went up, comes back down, but failed to break above the previous highs. And so at this point, we can clearly see that the market structure had already shifted. It went from forming higher highs and higher lows at first, to then failing to form another higher highs twice and started moving sideways. So based on this market structure, we can already identify that the market is currently ranging. Now let's look at another example. So here, we can see that initially, the price was on a clear downtrend, as it forms lower highs and lower lows. Next, we can see that the price went down, comes back up, but failed to form another lower lows. Then, we can see that the price goes back down the second time, comes back up, and again, failed to form another lower lows. And so, based on this, we can clearly see that the market structure had already shifted. It went from being on a clear downtrend to now moving within range. Now, once you've identified a ranging market, the next thing you want to do is drawing the key levels. And so you can draw a level of resistance above and a level of support below here. Now, there are a couple of reasons on why we draw these key levels. The first reason is because we want to determine the area of where the price is still considered ranging. Meaning, if the price goes out of one of these key levels, it shows us that the market is no longer ranging. The second reason is because we're establishing our trading zone. So as long as the price stays within this zone, we can still trade it using our range market strategy. But bear in mind, it's very rare to find ranging markets that moves perfectly between key levels like this. Most ranging markets will actually look like this, where the price may not touch the key levels perfectly. As you can see, there are some candles that overlap the levels, and even some that are not touching the levels at all. And this is perfectly fine, because remember, we're treating support and resistance as a general area, not as solid lines. Now, once you've identified your key levels, the next step is finding your entry signal. So for your entry signal, you want to take advantage of the price bouncing off those key levels. Let me show you an example. So here, we can see that at first, the price was in a small uptrend before it started moving sideways. And so we can draw a level of resistance above and a level of support below here. Now, if you look closely, you'll actually notice a pattern. Every time price hits a key level, it tends to reverse from it. As you can see, price went down, hits the key level, and reverses upwards. Again, it went down, hits the key level, and reverses upwards. And the same thing is happening above here. Price went up, hit, and reverses downwards. Again, it went up, hit, and reverses downwards. Now, as you look at the current price, you can see that it's touching the resistance level once again. And so, based on the previous pattern, it may indicate that the price will reverse from this level as well. So this is a good opportunity to take a short position. But keep in mind, there are also times where the price reverses even if it hasn't hit the key level, like in this example. Here, we can see that the market is on a range, and so you can draw a level of resistance above and a level of support below here. Next, you can see that in the past, price clearly respects these levels as it tends to bounce off after hitting them. However, if you look at the recent price, we can see that the price went down and reverses upwards immediately without even touching the support level. And after that, price went down the second time and reverses upwards. However, if you look closely, you can actually see that the price is reacting to this new key level instead of the old one. This is exactly why you should always keep an eye on new key levels that may form, because price doesn't have to react to just one key level exclusively. It can always react to new ones that forms along the way. Now moving on. Another type of ranging markets that you may encounter is called narrow ranging markets, which is when the distance between the upper and lower levels are too narrow. As a result, there isn't much room for the price to move around. This means that you won't be able to trade it using the key level bounce strategy that I showed you earlier. And so the best way to take advantage of this type of ranging market is to trade it using a breakout strategy instead. And the reason for that is because if markets are moving on a narrow range like this, it indicates that the price is consolidating. And usually, after the price consolidates, a breakout tends to happen afterwards. So if you know how to trade breakouts effectively, you can enter a position before the breakout happens and make a profit. So this is how the strategy works. The first step is you want to find a narrow ranging market, which can be identified by multiple small candles moving sideways erratically like this. And a quick tip, you can find them a lot easier on lower time frames such as the 1 minute to 15 minute time frame. Now, once you've identified a narrow ranging market, the next step is drawing the key levels. And so you want to draw a level of resistance above and a level of support below here. But remember, don't draw them too closely. Make sure to give them enough space for the price to move in between so that we can avoid false breakouts later on. Now, once you've drawn the key levels, the next step is figuring out the breakout direction. Will it happen to the upside or the downside? Now keep in mind, in a narrow ranging market, false breakouts happen very often. And so a simple trick that I like to use to avoid false breakouts is by waiting for a momentum candle to break out of the key level. So a momentum candle could be in the form of a big candle or multiple medium-sized candles with the same color. Let me show you how this works. Here, we can see that the price goes up and breaks above the resistance level. However, notice that the size of the candle that broke out is way too small to be classified as a momentum candle, meaning you don't want to take any positions yet, because this may just be a false breakout. Next, we can see that the price came back down, gets back up, and breaks above the resistance level once again. However, you can see that this time, it's a big green candle that broke out, which means we now have a momentum candle. So based on this, we can conclude that the breakout will likely happen to the upside. And so this is a good opportunity to take a buy position.